Well, good afternoon, everyone. Keith Udy with Mortgage Alliance and Rich Mortgage Group. And today we're going to talk about the Smith Maneuver. Some of you may or may not have heard of what the Smith Maneuver is, so we're going to help debunk some of maybe your myths you've heard about the Smith Maneuver and help you understand what the purpose is behind the Smith Maneuver. And we're fortunate to have Robinson Smith with us, who is the son of Fraser Smith, who originally came up with the Smith Maneuver. So that's a great benefit that we have today. Just need to share my screen here for you to make sure that we've got this. There we go. Why isn't this going to? Second here. So I am a Smith Maneuver certified professional through Robinson Smith's program. He has created certified professionals across the country in a variety of different aspects. Myself, as a mortgage broker, I completed his course, but I've also used the Smith Maneuver since 2005 myself, before the certification was even available. I am also a certified financial life professional and use that in my conversations with people so that I understand what their relationship to money, wealth, and worth is, so that we can create a financial life by design rather than one by accident. I work with Mortgage Alliance and Rich Mortgage Group here in Alberta. Fortunate, we were the top franchise in Mortgage Alliance in 2019, and we are going to finish first again in 2020. We're a finalist for Alberta Brokerage of the Year with Mortgage Awards of Excellence, and won that same award back in 2018. I've also been the Real Estate Professional of the Year with RAIN for 2017 and 2019, and I am a secondary suite specialist here in Calgary and understand the implications of that across the country and what that does for cash flow and properties. And in also how in relation you can use that with the Smith Maneuver to accelerate your tax savings. So one of the key questions when it comes to understanding your real estate investing or even using the Smith Maneuver are, what are your ultimate goals? Are you looking at future wealth, to pay less tax, to travel, lower your financial stress, or create a generational legacy? These are important things for you to understand and consider, as there is an expectation of what are those goals, because those goals help us to form and formulate the plan that's going to be best for you. So some of the challenges that you may have to achieving your goals will be that currently Canadians pay high taxes. So those for creating generational wealth and future wealth, paying high taxes gets in the way of that. There's also a high cost of living in Canada. So with the high cost of living and what's projected to be higher cost of living, how do you put yourself in a better position financially going forward? The high cost of mortgages from a future perspective, the amount of interest that you have to pay on a mortgage over the life of it can become very detrimental to building wealth. And inadequate pensions. Although the government has pensions and there's private pensions and stuff, a lot of these pensions we're finding out are underfunded. Are they going to be there for us in the future when we decide we want to tap into them? And people have inadequate retirement savings. People don't have the disposable income to be able to build their retirement. So the typical approach to wealth growth is to pay off your mortgage, which is not optional if you have one. You need to make your mortgage payments. And then hopefully try to save for retirement, which is optional. So through the Smith Maneuver, it's possible to actually achieve both. So by leveraging your debt for wealth growth, you don't want to be borrowing to consume, because this is not tax deductible. You want to be able to borrow to earn income, and then the interest on that borrowed money is tax deductible. The wealthy know how to make this work for them, and that's why they're in the top 10% in the country of earners, and you want to get there as well. So if you embrace tax deductible debt, you can help to exponentially grow your future wealth and create a financial life by design. The benefits of the Smith Maneuver is that you can generate tax deductions and reduce your tax burden. You can eliminate expensive non-deductible mortgage debt through the conversion process with the Smith Maneuver. And you get to take advantage of the compound growth when you start investing now with the money that you are moving through the Smith Maneuver process. And these benefits all start simultaneously when you start using the Smith Maneuver properly. It does not necessarily require any additional cash. Since you're already making mortgage payments and you're already paying down principal, you can leverage that principal pay down so that you can start growing and investing now. So how you do it, you need a proper readvanceable mortgage. Not all lenders offer the right mortgage product. That's why speaking with a mortgage broker such as myself is so important, because you need to have the right product to make this work properly. The wrong product can set you up and can cost you wealth growth. So that is a critical thing to understand and consider. And working with Smith Maneuver certified professionals, from your mortgage broker to your accountant to your financial planner and realtor, are so important, because they will all understand the information and knowledge in the same way to help you make sure that you're making the right decisions. So there's the plain Jane and accelerated methods. Do you want to just stick with the plain Jane? You can, or you can use some of the accelerated products. Now, we don't have the time today to be able to dive in deeply onto each of these, but the plain Jane is just where the principal you pay down on your mortgage is drawn out to invest into your investments to earn with the intent of earning income. Then there's the debt swap, the cash flow diversion, the cash flow dam, the drip, and the prime and the pump. And for real estate investors, the prime, the pump, and the cash flow diversion are two of the most common ones that are used. The debt swap somewhat. The drip is more related to dividend paying investments. So knowledge is power, and this is why knowledge becomes such an important part of real estate investing. So I've used the process of the Smith Maneuver myself since 2005. We 100% converted our mortgage into the Smith Maneuver over 2 years. We had tax refunds of $7,000 to $9,000 per year because of the Smith Maneuver. And this, I was actually working as an employee at the time, so taxes were being deducted from my paychecks. Now that I'm self-employed, it's more of a tax savings than a tax refund because of the previous implementation we had for it. Advisors at banks don't know how it works. In many cases, they've never even heard the term Smith Maneuver, and their eyes will go cross-eyed and roll back in their head if you present the term to them. And they won't know how to properly advise you and instruct you to be successful with it. A lot of financial planners don't know how it works. This is why Robinson's certification program is so important, is he can connect you with financial planners that are certified and know how it works. I also, for those financial planners that don't know how it works, and my clients have someone that they've already entrusted, I work with them together to help them understand what the objective and plan is and how it works so that everybody actually wins in the process. Because you, the client, need to be able to have that wealth growth that you're looking for, and your financial planner needs to understand that. And from the mortgage side, we need to make sure that you understand how to use your readvanceable mortgage to make it work to your advantage. So that's why I say use me as your certified mortgage broker to guide you through this process. If you're still confused, well, we've got a question and answer period here available today to be able to help answer more questions and help you to hopefully be less confused. And certainly there's the opportunity to arrange a call with me so that we can talk about it more. So I am a REIN trusted partner. If you haven't seen this, here it is. Well, that's the end of the presentation part. I'm going to open it up here for questions. So let's, if you can unmute yourself, if you have questions, I'll check and see if there's some questions here in the chat room, and we'll get to those as well. I know Robinson has been kindly answering some questions. So I see, I'll go back to the start here. Lena asked, can you email in the form of, Lena's asking, sorry, in the form of a readvanceable mortgage, broker saying, well, it's a higher rate. Well, so it's a slightly higher rate for most readvanceable mortgages compared to just a fixed term mortgage. But you're not getting the tax advantages from the fixed term mortgage either. So that's why it's more about interest rate. And this is why I always tell my investing clients, I tell all my clients and investing clients, there's more to a mortgage than rate. Getting the lowest rate may not give you the greatest advantage. Sure, you might, maybe you can go and get 1.89% or 1.79%, but it's got a maximum 10% prepayment privilege and a maximum 10% increase, not portable, and it has a bona fide sale clause that you can't refinance during the term if you were to so choose, because maybe you do renovations to your property. Well, now you've handcuffed yourself. So it's more, there's more to a mortgage than rate. And that's why working with a Smith Manoeuvre broker and understanding how this is going to financially impact you to the positive is so important. Does that answer your question, Lena? Jason is asking, what's the differentiation between a readvanceable mortgage and a HELOC? So often a HELOC is where it's a fixed amount that you have access to borrow. So let's say you go and you get a HELOC for $100,000. You will only ever be able to borrow or use $100,000. No matter, you can pay it down, you can pay down the $100,000 and you can borrow back up to $100,000, but that's it. A readvanceable mortgage is where you have a initial, say you have an initial fixed mortgage of $200,000 and you have a line of credit maybe of $100,000, but as you pay down the $200,000 portion of your mortgage, that becomes available to you in the line of credit. That's a huge distinction. And if you get the wrong product and you get that set up wrong, then you end up handcuffing yourself because you'll only ever have access to convert that $100,000. That $200,000, you would not be able to convert it until a refinance at some point in the future. So that's a really important, that's a place where people make a lot of mistake, is they think a HELOC is a readvanceable mortgage, and it's not. Two different products. Nick, I have a mortgage business and I'd like to save some taxes and pay down my mortgage at the same time. Broker or accountant that I can use in Toronto. Well, Nick, I'm licensed across Canada. I actually am doing Smith Manoeuvre mortgages for clients across Canada. Doing one right now for a client that's just outside of Toronto. So I can certainly help you with that. Can both a HELOC and readvanceable be used to apply the Smith Manoeuvre? The readvanceable mortgage is better. Yeah, so basically it goes back to what I said for Jason there, Kevin, and that is that they are completely different. The HELOC does not work in the same way and does not have the ability to create the advantages that a readvanceable mortgage does. What other questions do you guys have? Robinson, is there anything you'd like to add?
Well, I would be happy if I'm able to share my screen. I don't know if that's possible.
Just let me check. I think you can, but if not, I'll make you co-host.
Okay, well, there we go.
And there you go. Now you should be able to share.
Yeah, I thought maybe I could go through a real quick 5-minute demonstration of the Smith Manoeuvre calculator that you have access to, Keith.
Yeah, for sure.
Are you seeing the calculator here?
Yeah, you bet. It's there.
So real quickly, folks, this is going to be a real blur, but my annual income is $150,000. I've got a rental property, a proprietorship that brings in $36,000 and costs me $34,000 for the rental mortgage. I've got mutual fund assets of $10,000. And my marginal tax rate, this is based on BC, defaults to BC, 45.8. You can type in your actual if you know it down there. And now I go to mortgage information. I've got a $750,000 house, the mortgage balance of $450,000, and my rate on that is 2.9%. Defaults to 25-year AM, we'll leave that there. On the reborrowing side of this readvanceable mortgage, which is crucial, if you don't have a readvanceable mortgage, the train don't leave the station. So the rate on that is 2.45 prime plus a half, so 2.95 total borrowing rate. My investment assumptions, I'm going to type in 7% long-term forecasted growth rate. So this is where we start to see results here. This $769 is what I'm able to reinvest on a monthly basis. This is the very first month. Some of that mortgage payment goes to interest, some goes to principal. I'm going to reborrow that principal of $769 to invest. My tax refunds over the amortization are sitting at $50,000, and my net worth improvement is $280,000. That's just the very initial case. If I want to, this is pretty complex, but Keith knows all about this when you're talking to him about it. If I reduce the total loan I accept, I can improve my results a little bit. Now I want to apply my tax refunds against my mortgage each year that I get them. So this is where we'll start to see improvement in amortization here, because I'm prepaying my mortgage. This is just once a year. I'm taking 2.33 years off my mortgage. The debt swap accelerator says I've got $10,000 in investments. I'm going to redeem them for cash. I'm going to prepay my mortgage, borrow it back, and then buy the exact same investment if I want, or a different investment. Now I've got 3.08 years off my mortgage, $480,000 net worth improvement. And this net worth improvement means my portfolio is 875 offset by my deductible investment loan, gives me a net improvement of 480. And future lump sums, emergency cash, all these different things as regards the accelerators. Cash flow diversion. I'm investing $200 a month straight from my checking account. I'm going to first prepay my mortgage with the cash flow diversion accelerator and then reborrow to invest. 5.5 years off my mortgage, net worth improvement of 643. Cash flow dam accelerator. My rental property revenues $3,000 a month, $2,833 in expenses. So that rental revenue, I'm going to prepay my mortgage, my own mortgage, by $3,000. I'm going to reborrow that full $3,000. $2,833 is going to go to service expenses such as the rental property mortgage, but the difference of $167, if my math is correct, will be able to get invested in securities. So instead of 5.5 years taken off my mortgage and $643,000, I've taken off 17 and a half years of that non-deductible mortgage debt. I'm gone in 7.5 years rather than 25. And my net worth improvement, my portfolio is 1.25 million, 436 investment loans. So we subtract that, I get a net of 814. Prime the pump accelerator. I've got immediately available funds of $100,000 on the line of credit the day after I refinance, thanks to Keith, into my readvanceable mortgage. I can pull some, none, or all of it to invest. But if I want to pull, let's say, $80,000, I can do that. I can invest in securities. I can invest in a rental property so that I can now, maybe my first rental property, so I can implement the cash flow down. Maybe my second rental property, so I can boost the cash flow down. But if I pull this $80,000, say I invest in securities, it grows at that investment growth rate that I inputted earlier, then that 17.5 and 814 goes to 17.92 years saved and 1.26 million net worth improvement. My portfolio of 1.8 offset by my investment loan means a 1.266. And lastly, second to last, there's a graph which points out the green, my amortization if I don't do the Smith maneuver, and the blue, my amortization if I do. The red is my investment portfolio. And then I can go and I can print a report so that I can show this to friends and family and all that stuff. Here are all the assumptions I inputted, summarized for me. Here are the results summarized. The results panel on the right is summarized here in the document. And then my monthly process. What do I do? By how much? When do I do it? That sort of stuff. And that is the Smith Man calculator. With me all excited, hopped up on Coca-Cola. I know it was a quick one and it's confusing, but anyways, that's just to show the power.
Yeah, so yeah, thanks Robinson for going through that real quick. So there's a couple more questions. So can the bank reduce your advanceable line of credit if you don't use it? Gabriel, I've never heard of them doing that because they have already registered on your title for a certain value amount that they've agreed to finance you. So I've not heard of them reducing it. Monique asked, do you have to break our current mortgage to apply the Smith maneuver? Most often you do, Monique. It really depends on what your current mortgage is that you have and who your lender is as to what it may be set up as. A lot of people don't know how their current mortgage is set up. Nick asked, is it just the interest rate that is deductible on your gains or is there something more? I'm not 100% clear on your question, Nick, but what I think you're asking is, so the interest you pay on the funds you borrowed to earn income are tax deductible. Now, if you earn gains on your investment from what your investments were, those are taxed separately as income that you've earned from your investments. Let me know if that answers the question that you were directing to.
I'll just jump in here real quick. Basically, the interest you pay on that borrowing to invest is deducted from your income, regardless of whether your investment is actually to the positive or to the negative.
Yeah.
So you can deduct the interest that you pay from your income that leads to your tax refund. The gains you make on your investment, if you earn dividends or interest income throughout the course of the year in these non-registered investments, then they're taxable in that year as income or dividends, but you don't realize any capital gains tax if and until you actually sell the investment, which may be never. This is a very long-term strategy. If you want to die with this deductible debt and die with these investments in place because they're sending off monthly cash flow to support you in your retirement, then you do so. When you kick the bucket, when your day comes, your estate will deal with the investment loan either by redeeming some of the investment assets to pay that out, or maybe your heirs will decide they want to assume that investment loan, whatever the case may be.
Yeah, so thanks, Robinson. Yeah, so so a couple more questions. So Dan asks, would it make sense to break your current mortgage to start the Smith maneuver if you have a fixed and locked in mortgage? So yes, it can. And that's where the planning comes into place and doing an evaluation. So this kind of goes into Monique's question, which is, yes, I do assessments for people on the Smith maneuver to figure out what would work in their specific situation. And often what often happens is investors have $100,000 saved up that they're ready to go and put into a investment property and buy it. But they also have a mortgage on their home that's maybe locked in. And they're paying that mortgage, but they have no way to deduct any interest on that mortgage. It often can make sense to take that $100,000 and use it in the Smith maneuver by refinancing into a readvanceable and using the $100,000 to pay down the mortgage after the refinance, or in some cases making a pay down on the mortgage prior to, depending on who the lender is and what it is. But we work out the way to best convert that $100,000 that's going to go into your investment, so that you now have converted $100,000 as a lump sum right away. So you're now deducting the interest on that $100,000 from your tax, rather than just taking it from your cash savings account and sending it to the lawyer for buying your investment property and getting no tax advantage whatsoever. So Monique, yeah, reach out to me. Happy to go through your specific situation and see what options and solutions are there. Can use the Smith maneuver to invest in options contracts, typically selling options such as iron, condors, strangles. As long as the intent, the government rule says the intent is to earn income. And that's they don't define what that looks like, as other than you can't double dip on other advantages they already give through registered investments. So as long as your intent is to earn income, then and you can prove that to them if you were to ever get audited, that's what's important.
Yeah, and what I'll just add there is, I think we mentioned it earlier, but through my program, I'm accrediting mortgage brokers such as Keith, but also accountants and investment advisors. And when we get into these questions that are more in depth as particular investment products, that's one where I can't answer. You're not a client of mine. I'm not an investment advisor. I'm not an accountant. Any advice I do give, which is a yes or no, could be misconstrued or whatever the case. So we do have SMCP accountants and investment advisors. Reach out to info@smithman.net. If you're looking for one near you, we can set you up. But if you're looking for an SMCP mortgage broker, guess what? He's on this call right here.
Thank you. So Dan asks, what if you have a huge penalty that you have to pay to cancel this mortgage? So that's where I work with the Smith Manoeuvre certified accountants, or we can talk to your accountant to find out what their understanding is, so that we can make sure that you're maximizing that. There is the possibility that your penalty that you pay, if you are activating, I use the $100,000 example, that the penalty you pay, if you're activating $100,000 right away to do that, that you may be able to do a capital cost deduction over a period of time for that penalty. And I've talked to a Smith Manoeuvre certified accountant about this previously, and that is what they had talked about. Every person's situation is specific, but that's why talking to the accounting professionals is also critical to the process when you're setting up the Smith Manoeuvre, because they need to understand everything as well, so that you're not offside and that you're getting the maximum advantages that you should be by putting this in place.
And I will just add to that a real life case. An SMCP mortgage broker did an analysis, and it was worth it for the homeowner to break the mortgage and pay a $30,000 penalty, because the savings over the course of the remaining term, plus the deductibility of getting into the investments and the growth and all of the different things that were taken into consideration with this analysis, said it was worthwhile to do so. And so the client did it.
Yeah, and there's more than just there's several analyses. I also do a what if calculator for my clients when they are breaking the mortgage, to compare what the savings is on the overall interest over a period of time for a mortgage compared to the current interest rate, so that they can also see that savings. And there's a number of different ways I can work with that in addition to the Smith Manoeuvre, so we can see that it makes sense for you. And that's where, yeah, I understand that, Dan. Yeah, sometimes your penalty is $30K. The question is, what limitations are you doing? Like, if your penalty is $30K, that means you likely have a mortgage somewhere in the neighborhood of probably $400,000, while you're paying somewhere near $15,000, $16,000 a year in interest on that mortgage. Well, if you have the ability to convert that's $16,000 of tax deductible deductions you have, lowering your income, and in a 40% tax bracket, that's $4,000. So $620K mortgage. Yeah, so you're paying somewhere in the neighborhood of $20,000 of interest a year. So at 40%, that's $5,000 of tax returns that you're likely able to get once you have that mortgage fully converted. So it can make sense. Depending on when your renewal date is and any number of factors, there's things that we look at when it comes, those are all things to be considered. It's part of a deeper conversation. So Monique said, why are so many people, including trusted partners, not familiar with it? They're not familiar with it just because they haven't done the work to educate themselves to get it. It's something that I got interested in way back in 2005 and went, man, this is a miracle and it's something to do. So if you want to learn it, so I'm just going to repost again for everyone. If you want access to the book or the homeowner code, there's a link right there in the chat. You can get access to the book or the homeowner course through there. Those are great. It's a great way to educate yourself. If you just like some excerpts from the book, just as an introduction, email me. I can email you. We've got a great excerpt from the book to give you a little bit of an introduction so you can decide whether you want to take that next step and actually get the book or buy the homeowner course or move forward with the Smith Manoeuvre yourself.
And I will add brief, sorry, Keith, if
Yeah, go ahead, Rob.
just briefly, to answer that question, why so few people, I guess, are unaware of the Smith Manoeuvre. My dad developed at Fraser back in the mid-'80s. He put his private clients into it quietly for 15 years until he wrote his book in 2002. He spent the next 3 years going across Canada, speaking to the clients of mortgage brokers, investment advisors, accountants, etc. And then in 2005, he went back to advising. So that 3-year period is the only time when anyone named Smith was actively getting out there in front of the Canadian public. Since then, since 05, when he started advising again, I joined him in 06. In 2018, middle of 2018, I sold my advisory so that I could write my book on it and start doing these events, getting out, on the smithman.net media page, you'll see a lot of interviews I've done with a lot of different real estate investment groups, Darren Foros, Rain, Breakthrough, etc. So now the word's starting to get out. For many years, investment advisors, mortgage brokers have been putting their clients into the Smith Manoeuvre in their own local communities. But what you really want to do is make sure that the person you're using is a Smith Manoeuvre certified professional. I've heard many stories over the years of people who thought they were being put into the Smith Manoeuvre because their advisor, broker, whoever said, yeah, I know the Smith Manoeuvre, I'll do that for you. But they didn't know the Smith Manoeuvre. Maybe they thought they understood the Smith Manoeuvre, but they didn't. And the homeowner is certainly not going to understand, not going to be able to know whether their professional knows the Smith Manoeuvre or not. So use the SMCPs, contact us at info@smithman.net for SMCPs in your area. For anything other than a mortgage broker, as Keith said, he's licensed Canada-wide for mortgages, but we've got accountants, investment advisors, realtors who are SMCPs. Someone asked a question earlier, if this was possible in Quebec. Yes, we've got an SMCP team in Quebec. There are different rules as regards deductibility, but it is being done in Quebec with the help of our SMCP team.
Absolutely. Well, we're at the end of the lunchtime. If anyone has any further questions, is the homeowner course sufficient? I mean, it's there to help guide you. It doesn't give you the access to, for example, myself, the knowledge that I've gained over the last 15 years of using it myself. This is recorded. It'll be going to Rain, and Rain will be posting the recordings for all of the different breakout rooms. And so, yeah, Kevin, I'm happy to work with you to help you make sure that you're making the right choices and decisions. So feel free to reach out to me, anyone who has questions on the Smith Manoeuvre, and we'll get you on the right path to making sure that you're creating a financial life by design for yourself rather than one by accident, because together we all win, and together we can all create generations that are better off than theirs.